Could we have just witnessed another case of insider trading in 2025? What does the dark pool liquidity of Wall Street tell us about the next big move? And more importantly than any of this, where are the safe havens right now? As we predicted together over the last couple of sessions, we thought gold would sell off majorly. Now that it has, where is the next pair that we should be looking at? Is it Bitcoin or something else? In today's video, we'll take a look at all of that together, along with the gaps that probably need to be filled, whether the opportunity is now to the upside as potentially the Trump administration makes a big move and change, and of course, Google and many other big tech earnings coming up. Could it be that this particular chart holds the key? In today's video, we'll talk about everything from stocks to commodities to cryptos to cover everything that we need to know right now about markets. Guys, this is going to be a great one. Let's get into it right now together. Well, welcome back everybody to The Daily Show. My name is Tom, and today's video we have a lot to discuss. One of the rarest indicators almost triggered over the last 24 hours, which would have been absolutely amazing. We'll take a look at it. We need to discuss what tends to happen when we saw so much breadth. And of course, we need to go on about how this session unfolded, as it does seem to have been triggered by several different things. First up, of course, we know that Trump changed his rhetoric on China. That is, that we weren't going to go to zero tariffs, but that they need to be reduced. Now, according to Unusual Whales, we have here some information that lines up very well with those dark pool liquidity trades that we saw over the last 24 hours. So according to Unusual Whales, so at a private JP Morgan conference with US Secretary Scott Bessent, supposedly Bessent talked about the US and China calling the situation unsustainable. That rallied the markets on those comments, and of course, you can see here some large transactions came through. Now, this is becoming a big problem in 2025, and as we suspected, Wall Street was at the start of this, as we can see here with the big dark pool liquidity that led on to not only this rally, but then more substantial rallies, pushing us all the way into this resistance high. Now, since that point, it looks like there's been some kind of like walk back on these particular Chinese tariff kind of situation. We actually saw now the discussion going, oh, maybe we're not going to take it back. And this is causing this instability in markets and really pressuring, I guess, a lot of people from the investment and, of course, day trading side to be faster and also to be more risk managed when it comes to these markets. Now, we did end up finding key resistance here, and we'll talk about that later on. But just remember, these dark pool liquidity trades are incredibly important to pay attention to, as is the news right now. If we see things like tariffs get reduced, which I still suspect will end up happening over the next coming months, then we could see markets recover. But as soon as we change that rhetoric back or don't do anything about it or less information comes out, remember that is generally going to degrade the market as people take profit. Now, why is this? Well, as you can see here, the soft data right now is falling off a cliff. According to this latest chart here from Augur Infinity, we can see here that the softness in the US data sentiment still hasn't spilled over into the hard data. But if that tends to happen, then we've got a big problem. We often saw in the previous video, we talked about the CapEx right now, and basically investment in the long term, that is the long term of the market in the US, is dropping to really, really bad levels. And this is showing that maybe the investment into the future in the US markets is going to be a huge problem. Remember, we need those investments to sustain our high PE ratios that we're currently trading. Now, what about some good news? Well, one piece of good news is that Barclays' high yield credit spread actually seems to have come off its kind of freak out zone. Now, this is good because, of course, we need this to happen. We need, in general, bonds to stop freaking out. And we really remain with watching the US 30Y, as every single time anything goes close to that 5% reading, which was getting closer over the last 24 hours, we seem to be seeing an announcement from either the Fed or the US government saying, oh, here's something. So we know that basically bonds is the market to watch this year. And of course, we will be tracking it here on the channel, so make sure to subscribe for that. But 5% on the US 30Y, that could be actually a trigger almost every time, either for the plunge protection team from the Federal Reserve or for some rhetoric around China tariffs. And it seems to be this kind of like pull-push thing that we're getting in these markets right now. Not unexpected, as we already know that's statistically what happens, but certainly frustrating for many of us out there, especially if you're looking at that stability to try to then use data such as we do for the prediction powers. Now let's have a look at one good piece of data that almost triggered, and this is thanks to Subutrade, and that is the Zweig breadth thrust. Now these are pretty rare. We almost triggered it over the last 24 hours, and this would have been a huge deal for the bulls. Unfortunately, it did not trigger, but I thought I'd bring it up because, of course, we discussed this first last week saying it could have happened, and it almost did, and then it unfortunately failed. Now, the question is, what kind of path are we following? Are we still on the 1990s rhetoric? Are we still following the exact same read? Now, if that is true, could we be looking at 2 years more of bullishness should we actually come back up? Also, if we are following this, which remember, we are literally at the sell here signal right now, or very close to it, as you'll see later on in the video, then could we be going for a double bottom or a new low? Now, this really comes back to this rhetoric around the tariffs. And as you guys know, we'll be on top of that every single step of the way. There's so much misinformation, disinformation, all sorts of stuff going on. We'll try to bring you the best stuff as we see it. Now, as you can see here, if this is going to happen, then this could take us out of the recessionary path. It's very important what happens here in terms of market structure. Obviously, if we drop new lows or we sit here and then drop new lows later on, we are following what's customarily called a recession path after a Federal Reserve cut, and we already suspect that may have been broken. So it's super important that markets start to find bullishness once again. Now, we also saw a pretty good read earlier this week with that big update, which obviously was that we saw 2 of the past 10 days with over 96% breadth in them. Now, the problem with this stat a little bit is that, of course, why are we getting this 96% breadth? Because the tariff talk is coming off and then going back on and then coming off and then going back on. So what that's doing is it's causing these huge movements with massive funds going in for short, sharp moves. Now, the good news is that everything seems to be overlaying with what we've already discussed before. It's likely we found near the lows over the last 2 weeks because of that peak fear. And that traditionally we will sit around for 2 months going up, down, and all around as we form structure. Now, I think it's also important to note that while there have been some horror show periods, such as this one over here, a lot of these end up in doubling bottom style patterns, which I think could be very good for investors, position-based traders, and day traders alike, like many of us out there. Now, speaking of day traders, did we just see somebody kind of get back involved in the VIX? Well, according to the UVXY, we saw a fairly large trade come in near the close, which is in the short-term, ultra-short futures, and that came in right near the end. So that's all obviously a little bit of an inkling about somebody getting involved. And we also saw some large trades coming in one of the Bitcoin ETFs. Now, we had massive inflows into Bitcoin as word got around. Luckily, we were on top of this one together, that possibly there could be a kind of overlap between gold and how it was running and Bitcoin. And as soon as Bitcoin got crossed that higher high, it went straight into the next resistance zone, which it's now hit. Now, we just saw the number 1 largest trade ever recorded since inception on this Bitcoin fund. And although that may not make you want to get out of it, we never ignore large trades. As you guys can see here, number 3 led to a massive rally. Number 2 led to a massive sell. Number 1, well, we'll leave that for question mark for now. But certainly we are at least the first form of resistance for Bitcoin. It was a massive session, so, no doubt someone's going to take some profit. Smart money flow is still starting to come in around these lows. Most of that seems to be coming from these big banks trying to get involved in it. Now, why are they doing that? Well, of course, they're hearing all this rhetoric about potentially tariffs and stuff de-escalating. And I guess, look, we're really just using or looking for India news or China news right now. The market only cares about those, and it's looking for that kind of information. It's going to be a day-by-day, minute-by-minute style market until we see these things kind of resume and improve. Now, global gold ETF flows, of course, everyone was so concerned about the world market and, of course, everything else that we saw everybody floating into gold. And this is just another chart to illustrate here from macro charts why we were so worried about the gold move. Now, if you've been watching the channel for years, you would know that for 2.5 years, we were super bullish on gold. And that changed about 2 to 3 sessions ago, as we unfortunately came to the realization that it was too fast, too quick, and that it was likely to get some form of blow off. Now, since that point, we've obviously seen gold suffer one of the worst trading sessions it has in years, but that wasn't so for one of our other favorite metals recently, which has been silver. And I think it's starting to catch a little bit of news here from some of the people in the know, which is specifically a ratio we've talked about several times. Gold to silver ratio is in the dirt. So what that basically means is that whenever gold and silver have really met this type of disproportionate valuation, silver has improved in price. Now you can go back into the 1940s, 1970s, any of these periods of times, and you can see here that silver is now historically undervalued at rates that we haven't seen in a very, very long time. And of course here, Otavio has actually come up with this. Obviously, we've shared several charts ourselves. You can just put gold, silver inside of the chart, but that is a really key point. Now, the problem is gold going to recover? And well, that is a good question. If we're in stagflation, then the answer is going to be yes. Of course, if you are a believer in stagflation, the answer is going to be yes. It's probably my belief for now that we'll go into a period of consolidation for gold. And a lot of this is because when we saw that tariff announcement, de-escalation, we instantly saw gold kind of clip some of the top off. And what that's telling us is that money flows out of that safe haven and it's going back into the markets and going into alternative assets. So gold may actually sit for a little while in a range, more so than it has done for months. And a lot of this has to do with some big trades. Again, we saw this only a few sessions ago. It was a warning sign, maybe something's going wrong with gold. And so far, of course, it's back down to those prices. Now, what we have seen is when gold has gone and done this huge move, the rate of change going above 30, etc., that actually has tipped off things like Bitcoin in the past. And we only have a few case scenarios for this. But since we first reported on this, Bitcoin, of course, has gone absolutely bonkers. There could still be moves for Bitcoin, and obviously people are getting super excited. We saw things like Solana and other coins that we'll look at later on actually improving above their highs. But for now, a lot around resistance. Now, what's going to kick off the rest of the market is really going to come back to earnings. And of course, we have some of the biggest earnings so far coming in less than 24 hours, Intel and Google. Now, Google in particular is going to be the one that people are watching. And do remember, it's expected to move around 7.5% based on the options market. That is plus or minus. Now, we saw Tesla move around the right amount that it was going to. It ended up doing, I think it was like 12% or something if you look at both the close and then the next session. So it went pretty bonkers. It was a case of sell the rumor, buy the fact, even with the terrible earnings. But we will have a deep dive for Google. I'm particularly interested in Google's result. And obviously, Intel's already come out and said, we're restructuring, we're firing staff, and that's pushed the stock back up. So, earnings season so far, I would say, has been okay. Certainly no worries there. But, the problem is the future guidance. And the future guidance, we're just not getting that much information. Now, remember this chart. This is all the bear markets in history. We did hit a technical bear market. Whenever we do this, guys, what happens? Well, the thing about a technical bear market is most of them end up in recessions. Now, there are 3 cases where that didn't happen: 66, 87, 22. I think we're following something like this, or a 1990s analog, which obviously ended up in a recession anyway. So you've just got to remember that we're at that late cycle part of the markets. And whenever you're here, you've got to think about what sectors tend to do well. And it's our kind of opinion that usually you see staples doing really well, you see utilities, you see healthcare, although there are tariffs on healthcare at the moment, and you also see the back end of the financials do okay. Now, that's the kind of thing that we've seen pick up. You can see here the last 5 days, regional banks have been the best. And that's kind of important to note that whenever you're looking at these types of things, it's really about, what sectors are going well. And recently, especially this year, staples, utilities, healthcare have held their own the best, and they've been our favorites. Now, what about the plunge protection team? Have we seen the Fed get involved, or is this just all basically on the US government at this stage? Well, the Fed was getting involved. A lot of central banks around the world were pouring in liquidity, and then all of a sudden they've stopped doing so. Now, we're going to continue to track this because, of course, as we get the data, we might see incredible injections back into the liquidity markets. If that happens, that's a good supporting force, and I suspect it will happen at some point. Now, we did end up finding resistance over the last 24 hours. We ended up going to the 54.80 zone and then finding that sell-off. It was more based on the news. Of course, we saw some backtracking on the tariff discussion, mentioning that, oh no, we're not going to change tariffs on China. You know, it is really up, down, all around in terms of this news that's coming through. But that ended up rejecting the market back underneath that all-important daily 200. What seemed assured close to the end of the day ended up rejecting back down. Now, this opens up a few things. Number one, we did actually kind of reverse this island reversal back upwards. And of course, we have gaps to fill. So if we actually had a look here, we should move our gap fill down to this area, 52.90. And that seems more likely the kind of area that you would be targeting if you were a bull, because it's around that 50% Fibonacci zone. Now, it's important that we do fill gaps. Usually you want to fill most of the gaps throughout history. However, the main thing is we still have not seen the market hit that most traded zone of 5,600 or that 5,670, which I think is still holds the main level of supply. Either way, by backtracking this stuff on the China tariffs, that of course puts the market in a bit more of a freakout zone. And that's why we're starting to see this kind of more head and shoulders style pattern now that's forming with a neckline that's now sitting at around 53.50. And as you guys can see here, the market has suffered from that resistance high. Here are the updated options high and low levels so you guys can see them. We did end up changing trend on the small timeframes to the upside, which does open up more buyers between the 52.80, 52.40 kind of area. The 50 fib and the 61.8 fib will be worth watching from a day trader's perspective. And that would also, I believe, complete this small head and shoulders if it was to occur. So if we actually took this distance and we extrapolated that out, which we'll do here together right now, you can kind of see, yeah, 52.40 would be the range. And that actually makes sense to the demand. So this could be gap filly kind of like area of interest. If we do find buyers here, we push back up into these highs, I think it's likely we break it. And this is where the real resistance or the shorters sit. And all of this really still follows that 1998 analog, which is that we basically could do this. We basically could do this. You know, this is the kind of thing. It really is in the case of the tariffs. You know, what's going to go on with the tariffs? Now, I think it's important that we don't forget, though, that the damage has been partially done and it is long sustaining. So this is going to hurt future growth regardless. Remember, 3 to 6 months of inventory are being held by a lot of businesses. So people will not feel the tariffs. Tariffs front load demand. So that means everyone goes and buys stuff. So you do tend to see some pretty good economic activity, at least initially, and then things go worse. And I'm sure Wall Street's well aware of this, as we all are, but at the same time, it is there. Now, pretty much it seems like the puts are everywhere here for June, but that's June. If we look at the OPEC, not the OPEX, the 0DTE expirations, you can see here 5,500, too many calls hitting that. No wonder we tried to sell off over the last 24 hours. Look at those calls everywhere. And it seems like we've got like kind of like a 52.80 put over the next 24 hours. And then if we go to the next sessions, it's a lot of calls sitting at 53.50, which is just underneath where we currently are. And then again at 5,400-ish zone. So it seems to be pretty much all around in terms of the options. Yeah, nothing much to really garner there, I don't think, other than 5,500 is a clear call wall in the markets. When it comes to Tesla, you can see here the 260 was too much for it. That's what we suspected after the earnings, and we still remain trapped. Even though the earnings were bad, the market rallied. And of course, here we've got the 220, and nothing really has changed. The 220 and the 260. And then if we go from 260, we go to 280, then we go to 295, and then of course 220 breaks, we go to 200, then 170. I mean, they're all the key levels to look at from the options perspective, and they line up pretty well when we look at the charts later on. Let's now move over to NVIDIA. NVIDIA is kind of the same thing. It actually did rally okay. It's obviously holding above 100, which is kind of nice. Still not at the 105, 106 level, which is where we see all the positive gamma start to come back through. And at this stage, of course, we've just got the market sitting on what probably is a fairly decent support between 95 and 100. So worth watching. Obviously, at this point, I'd have to say the trade war is all about semiconductors. So they're going to be the ones that boost huge if a deal is done. But at this stage, obviously, there's a lot of bad sentiment around them. 5% is worth watching. Never lose sight of having an alert above here. We seem to see the plunge protection team or the US government or something come in every time this hits. Obviously, bonds are super important. and therefore yields need to be watched. When we take a look here at high yield spreads, we can see here they've dropped off. Obviously is a good sign if you're trying to buy the dip or buy like a position. When we see bonds freaking out, then of course you need to be worried. But this is usually a good sign that we're forming structural base. And it's something we've suspected on the channel for quite some time. Since we saw that panic buy the other day of 9%, as soon as we saw structure low down there, everything triggered towards, an investor or a position-based buyer. We talked about this in our private community. We talked about this in our advanced course, etc. The main thing, and here on the channel, the main thing was that it was just traditionally where you'd usually see structure base. And again, even if a new low happens, it's usually not going to be that much lower because fear happens and we then structure up. And then if we get more bad news, then of course it will tank and get worse. But usually we see structure. Speaking of structure, treasuries have come back into focus. Obviously, we can see what the tariff news does to treasuries, pushes yields down, absolutely makes treasuries go up. And they're at a pretty good level of support. Although, they're not usually a very good trade. Some people like them as investments. They're at an interesting level. Now, as we've also suspected, everyone talks bad about the US dollar, and then all of a sudden it starts to rally back up. Very heavy level of demand, key level here at 100 or parity. If we break through that, I think that it could be actually up for the dollar, not down. So for at least the short period here, although we still maintain weakness in the dollar across the board, which we have all year, this could be a very interesting point. We'll watch that. It's going to open up a few currency trades. Gold suffered one of its worst trading sessions in years. No real surprise. Finding a little bit of buying right now. I wouldn't say this is anywhere in particular. It's not this level of demand or this level of demand. So to me, it means nothing. And we certainly haven't hit one of those more classic signs, such as the weekly 20. I mean, the weekly 20 is probably going to hit around 3,055. So has gold finished its great run for now? It seems more likely than not it's in stabilization at this point. So that is more sideways to down for a little while now. But then comes silver. Now, we are enjoying silver. Obviously, I like silver from the ratio. Big close over the last 24 hours, snapping all of these weak rejection wicks. So basically, that is showing, there's a buyer here. We've hit this 34.20 bazillions of times. And obviously, we keep pressuring it and we are unable to break. Now, I think the most important thing to understand here is when you go back through history, you'll see how important this level was. And this is such a hard level to break. But if it does break, wow. I mean, could we be going to 40 plus an ounce? Could silver be finally playing catch up? What is your opinion? Let us know in the comments down below. Some significant stuff here. Big breakout, pullbacks I'd like to think of met by bull demand. Hopefully it's silver's time in the sun. Now let's move over to US oil. Geopolitical tensions, all sorts of things. Bit of an issue. Still technically alive in the inverse head and shoulders. Need new high. I've got an alert here to update if that does happen, guys. That'll be a good sign that we could move towards 70 a barrel. For now, neutral. It's pretty, tough out there. 260, too much for Tesla. That's the call level. We sold off. We're really not in particularly any zone of interest anymore. We're more at the short zone than the buy zone. And obviously we've seen this a few times. It's really just the options levels on Tesla that matter at the moment. And that's what we kind of still maintain. Move over to Nvidia. It rallied up. Not bad. I mean, of course it did rally. It's technically an island reversal. It came off the 61.8 fib. If you were game enough to buy that before we found out about the JP Morgan meeting, then on top of that, we obviously saw a very nice gain. I'd like to say these hold. I mean, if you look at the mags, which we alluded to at the start of the video, these seem to be, still holding that daily kind of 20 on the way down. But again, 61.8 fib rallies up. We make a new high. That's a big deal. So we have to watch this. If we do not get the biggest tech stocks in the world rallying, it's very unlikely that the market can actually pull out really good numbers. Remember, if defensives move, good for people in defensives, not going to move the index that much. What about Intel? Intel jumped, as you can see here, based on cutting a bunch of jobs. We'll see what the earnings does over the next 24 hours. And Google rallied up pretty nicely after hitting that 61.8. Actually went early. So you can see here, had a nice session. Again, this daily 20 though, too much for it. I mean, long leg doji, waiting for the earnings announcement. We'll report that soon. HSI, what's going on? Well, you guys can see here that it's kind of in the middle of nowhere. It's not filled the gap, which is at 22.8. And yeah, it's okay. But again, the tariffs, everything else causing a little bit of instability. Still bullish on the liquidity being pushed into China, which obviously has been our move for the last year and a bit. And yeah, for now, it's good from the liquidity, good from China not stopping on that. I don't think they will. But at the same time, the issue is that we just don't have that economic stability at this stage. NASDAQ pushed up to resistance. No surprises, it sold off. S&P was the better of the reads. And then, of course, you can trade the NASDAQ as an equivalent. And then we've got a gap fill potential. I would use the S&P chart that we did before. And then if you wish to trade the NASDAQ, okay, you could do that. But yeah, in general, it's probably kind of found resistance. And unfortunately, with the flip-flop nature of the tariffs, that's causing, of course, huge rallies and huge sells. And we're seeing that in those dark pools. When we move over to the crypto world, you can see here, Solana did pretty well. Actually made a higher high off this high here. Again, Solana tends to follow Bitcoin first. It's usually the second coin to go, more so than Ethereum. And you can see here, Bitcoin hit that first resistance straight away. This is all a resistance supply zone, so it might consolidate a little bit after that massive inflow. But I think it got a lot of people excited, and obviously, people were going ballistic on talking about MSTR once again. It's funny how fast news travels in this world, and everyone was going double bottom, double bottom. Yeah, I mean, I don't disagree. I mean, you've obviously seen some pretty solid strength at 240, but just remember, if you're going to look at MSTR, you're really just doing analysis on Bitcoin. If you believe Bitcoin's going to rally out more, then MSTR should be able to follow it. It's basically a proxy after all, with, of course, a different system underneath. So make sure to be aware of that. In terms of news, guys, we are almost at the end of the week. There are, of course, more trade sessions, but there are a lot of bank holidays from different places around the world, including here in Australia. So that will reduce liquidity throughout Friday. And just remember as well that it's all going to come down to these news events. At the moment, the market is driven by fear. It's driven by news events. It's driven by announcements. And that means that everything can flip just like that. So make sure you've got your risk management under control as much as you can. If you want to, follow us over on X. Make sure to subscribe. Make sure to smash that bell icon. And I guess to summarize the market right now, we're obviously seeing some unusual activity when it comes to people finding out about certain information, according to Unusual Whales. And I guess, this is an issue because what it's doing is it's causing these huge trades. Yes, they're going to technical levels, and that's the good thing. But it really just puts in focus, we've got to watch the bond yields. I mean, bonds. We will not stop following them all year. I think they have to be on the channel. Thank you so much. We'll see you in the next one. Bye for now.